The median American in their late 40s carries a net worth of roughly $247,000. The wealthiest 1% of Americans hold more stock market equity than the bottom 90% put together. Those aren't two unrelated statistics. They're the same reality described from opposite ends of the same flawed system. Here's what I need you to grasp before we go any further. The distance between those two groups isn't explained by how much each side managed to set aside. It's explained by how they deployed what they had. The larger group was sold the idea of spreading everything around. The smaller group operated with focused conviction. And according to Federal Reserve data running through 2025, that gap has been growing without a single pause for more than 3 decades. Before I explain why, let me hand you the number that makes the next 15 minutes genuinely worth your attention. According to Dalbar's quantitative analysis of investor behavior, the research organization that has been tracking this divide since 1985, in 2024, the S&P 500 delivered a 25% return. The average equity fund investor captured 16.54%. That's an 8.48 percentage point shortfall. In the fourth strongest year for stock markets in the past decade, a year where doing absolutely nothing inside an index fund would have meaningfully grown your wealth, the average American investor managed to collect only 2/3 of what was available. And 2024 stretched a losing streak that now runs 15 consecutive years of underperformance. This isn't a story about intelligence, it's a story about structure. Today, I'm going to walk you through precisely why the standard diversification playbook is the actual engine producing this outcome, and what the research tells us about how genuine wealth actually gets built. Here's the central argument. Conventional diversification, as it's been packaged and sold to most American investors, is not a wealth-building strategy. It is a risk management framework that academics designed for institutional money managers in the 1960s, then rebranded and marketed to everyday investors as the road to financial independence. Those are two fundamentally different things. The confusion between them is conservatively costing the average 45-year-old $400,000 in eventual purchasing power. I'm going to show you 4 things. First, why the behavior gap isn't purely psychological. It's structurally produced by holding things you don't genuinely understand. Second, a peer-reviewed academic study out of Arizona State University that should have permanently reshaped how we approach portfolio construction. Third, who benefits from keeping you over-diversified and why that incentive runs directly counter to yours. And fourth, what the unglamorous, unexciting, genuinely effective middle ground looks like for someone who isn't a legendary investor and has no desire to become one. I have real money on the line here. Multiple hundreds of thousands of dollars invested. Over a decade running my own business, surrounded by accountants and financial attorneys who showed me how capital actually moves. The first thing every one of them agreed on was this. Diversification beyond a certain point is a product being sold to you, not a strategy being constructed for you. Before we get into the compounding mess of financial incentives and academic findings, I want to offer you a mental image I'll return to several times because it explains more cleanly than any equation what is actually happening inside your portfolio. Picture 1 tablespoon of butter. Just 1. You could spread it deliberately across 2 slices of toast and end up with 2 genuinely satisfying pieces of bread. Or, following the standard financial industry recommendation, you could attempt to cover 40 slices. What you produce is 40 pieces of barely coated, mostly dry cardboard. You haven't managed your butter more efficiently. You haven't reduced your butter risk. You've simply created 40 disappointing pieces of toast instead of 2 good ones. The butter is your capital. The toast is your investments. And Wall Street has been selling you cardboard for decades. Hold on to that image. We'll need it again shortly. In a few minutes, I'm going to walk you through a data set that reframes the entire question of why you own what you own. But first, I need to address something that looks like a behavioral problem and actually isn't. Here's the reality of holding 40 different positions across 12 asset classes. You don't deeply understand any of them. You simply can't. There are only so many hours available. If you're carrying global small cap value funds alongside bond ETFs, alongside sector funds, alongside three separate S&P 500 trackers, you don't have a portfolio. You have a collection of things you skimmed about once and are now hoping someone else is monitoring. And when markets fall, which they do regularly and sometimes severely, you panic across all 40 positions simultaneously because you don't understand your holdings well enough to know whether the fear is even justified. So you do exactly what Dalbar has documented every single year since 1985. You sell at the worst possible moment. Redemptions from equity funds occurred in every single quarter of 2024. The most significant outflows came in the third quarter, right before a significant market rally. Dalbar measured what they call a guess-right ratio, meaning how often the average investor correctly times their entries and exits. In 2024, it dropped to 25%. That's a record low. Investors correctly predict market direction 1 out of every 4 attempts. Let's convert that into actual dollars. A buy and hold investor who began January 1st, 2024 with $100,000 in an S&P 500 fund finished the year with $125,200. The average investor making the behavioral moves Dalbar tracked ended up with $112,774. Roughly $12,000 disappeared, not from picking bad companies, but from poorly timed decisions. Now extend that across 20 years. That same $100,000 left completely untouched in an index fund would grow to $717,500. The average investor, whipsawed by those same types of decisions repeated year after year, ends up at $345,614. That's a $371,000 difference. Not produced by bad companies, produced by bad behavior around perfectly ordinary investments. Here's a reversal you probably aren't expecting. You think the problem is behavior. You assume the solution is discipline. Just stop panic selling. Be more patient. Stay the course. That's the standard prescription. But the behavior is actually a symptom. The underlying condition is owning things you don't understand well enough to hold through turbulence. Warren Buffett wrote in his 1993 Berkshire Hathaway annual letter that portfolio concentration may well decrease risk if it raises, as it should, both the intensity with which an investor thinks about a business and the comfort level he must feel with its economic characteristics before buying into it. If you own 6 companies you genuinely understand, a 30% decline in one of them triggers research, not panic. If you own 40 things you barely grasp, a 5% drop triggers alarm across all 40 simultaneously. 1 tablespoon of butter, 40 pieces of toast, 40 panic responses. None of them rational because none of the positions are understood well enough to be held rationally. Stay with me, because the next section permanently changes how you should think about which investments actually produce wealth. In 2017, Professor Hendrik Bessembinder of Arizona State University published a paper titled, "Do Stocks Outperform Treasury Bills?" He examined every single common stock in the CRSP database, the most comprehensive record of American stock market history, spanning 1926 through 2016. More than 25,000 individual stocks, 9 decades of data. His findings should have triggered a fundamental crisis in how the financial industry teaches portfolio construction. They did not. Here is what he discovered. When you compound each stock's returns across its complete lifetime in the database, roughly 4 out of every 7 common stocks, 57%, failed to outperform the return of a 1-month treasury bill. They underperformed cash, not across one difficult decade, across their entire publicly listed lifetime. Even more striking when measured by actual wealth creation, the entire net gain of the U.S. stock market above treasury bills since 1926 is attributable to the top-performing 4% of listed companies. 4%. The remaining 96% in aggregate matched cash. Let that settle for a moment. Everything. The entire century of stock market wealth that persuaded generations of Americans to invest in equities. The complete academic and financial industry argument for why you should place your savings in the market. All of it originates from 4% of the companies that have ever traded publicly. And Besson Bender's updated research through 2022 found that just 72 companies representing 0.26% of all stocks ever listed account for half of all net shareholder wealth creation since 1926. Despite the fact that investments in the majority of stocks reduced rather than increased shareholder wealth, U.S. stock market investments on net grew shareholder wealth by $47.4 trillion between 1926 and 2019. The degree to which that wealth creation is concentrated among a handful of top performers has intensified over time and was especially pronounced in recent years when just 5 companies accounted for 22% of net wealth creation. Now here's the logical implication the financial industry has been carefully sidestepping for years. If 4% of stocks produce all the gains above cash, and your strategy is to hold all stocks equally. Because broad diversification is the prudent approach, you are mathematically guaranteeing that 96% of your portfolio contributes nothing beyond what a bank account would return. The entire premise of why diversification for protection rests on the idea that you must own everything to capture the gains. But the academic evidence says you need to own a specific 4% to capture the gains. Owning everything means carrying 96% dead weight. But don't index funds solve this problem? If you own the entire S&P 500, don't you automatically include that 4% without having to identify it? Yes. And this is actually the most powerful argument in this entire discussion, just not in the direction most advisors typically take it. Hold that thread. We'll return to it. Of all active large-cap U.S. equity funds measured, 79% underperformed the S&P 500 in 2025. That's worse than the 65% rate recorded in 2024, and the fourth worst year for active large-cap managers across the 25-year history of the SPIVA scorecards. Over the 15-year period ending December 2024, not a single U.S. equity fund category had a majority of active managers beating their benchmarks. 0 categories out of 22. Over 20 years, that figure climbs to 92% of domestic funds, underperforming their respective benchmarks. Consider what this actually means. If you're paying an advisor or purchasing actively managed mutual funds because you want professional assistance identifying the right stocks, you carry a 92% historical probability of finishing behind an unmanaged index fund. 9 out of 10 over 20 years. And then there are the fees. Fee drag compounds exponentially, not in a straight line. A 0.5% annual fee difference sounds trivially small, but costs approximately $59,100 over 20 years and $165,800 over 30 years on a $100,000 starting investment. The gap nearly triples between year 20 and year 30 because compounding has a larger base to erode in the later years. Scale that to a $1 million portfolio. A 1% annual fee could reduce your portfolio by roughly 25% over 30 years, translating to nearly $1.9 million in lost value on a $1 million investment. Not from bad investments, not from market crashes. From the percentage point you hand over every year to someone managing 40 fund pie charts and producing quarterly newsletters. 1 tablespoon of butter, 40 fees, 40 rebalancing recommendations, 40 quarterly reports. Nobody reads past page 1. Here is where I need to tell you something about the infrastructure keeping all of this in place. Think about what the financial industry actually sells. Actively managed funds, wrap accounts, multi-asset allocation products, professionally managed portfolios. Every single one of these requires you to hold many positions and to need ongoing help managing them. An advisor cannot build a scalable business around clients who own 5 companies. They understand deeply and never require rebalancing. That's one conversation every 3 years. But an advisor running diversified portfolios across hundreds of clients, each holding 40-plus positions across multiple asset classes, is operating something that scales cleanly and charges accordingly. There's also a structural legal dimension most investors have never encountered. Fiduciaries, meaning advisors legally obligated to act in your interest, are frequently constrained by the modern legal definition of prudent investing, which is built on modern portfolio theory, which is built on broad diversification. Recommending a concentrated portfolio to a retail client is, in many advisory contexts, a compliance concern, regardless of whether that client genuinely understands and has real conviction in the specific positions involved. Your advisor isn't diversifying you because they ran the numbers and determined it's personally optimal for you. They're diversifying you because the entire legal and compliance framework of their industry treats concentration as reckless by default. One fund founder put it plainly: no hospital wings or college dormitories have ever been named after someone who invested in index funds. They've been named by people who invested in one or two companies and stayed with them for an extended period. The wealthiest 1% held approximately 31% of total household net worth in 2025. That same group holds more equity than the bottom 90% combined. Since 1989, the richest 1% have seen their household wealth grow more than fourfold, from $11.74 trillion to $50 trillion. Their share of national wealth expanded from 23% in 1989 to 30.9% in 2024. The structural difference isn't that the wealthy were more skilled at identifying winning stocks. It's that they held genuine conviction about a small number of things, understood them deeply enough to hold steady when everything felt like a crisis, and paid almost nothing in fees to do it. Now let me tell you about someone who wasn't doing any of that. About 3 years ago, a friend walked me through his financial picture. We'll call him David. He's an engineer in his mid-40s, earns solid money, and has been doing everything correctly since his early 30s. Maximizing his 401k contributions, rebalancing twice annually, diversifying across 15 different funds covering large cap, small cap, international developed markets, emerging markets, bonds, real estate investment trusts, inflation-protected securities, dividend growth, and sector-specific technology. His advisor had given him a beautifully designed pie chart featuring 11 distinct colors. David had approximately $320,000 in retirement savings at 45, which sounds reasonable until you actually calculate what it cost him to reach that point. He had been contributing roughly $1,200 per month for 15 years, totaling $180,000 in contributions. His all-in fee load across advisor charges and fund expense ratios was approximately 1.8% annually. At a 7% gross market return, he was netting roughly 5.2%, and that's before accounting for the behavioral gap, the quarterly check-ins, and the allocation shifts made in response to financial headlines. By the time he moved money out of equities in the third quarter of 2024, right before the rally, he was tracking approximately $500,000 below where those same contributions at a 7% net return would have placed him. And he had absolutely no idea. The pie chart was too colorful to suggest anything was wrong. Here's the section where I want to discuss what the research actually recommends, and why it's the part nobody is compensated to explain. There are 3 distinct levels to this conversation, and most financial content stops at level 1. Level 1 is straightforward. Stop attempting to pick individual winners. Don't pay for active management. Purchase a broad market index fund and hold it. This is the SPIVA data applied in practice. This is why the same investor who built a career on concentrated positions reportedly directed that 90% of the money left to his wife be invested in a low-cost S&P 500 index fund. Why? Because she is not that investor. For people who lack the time, expertise, and temperament to build genuine conviction positions, Level 1 outperforms 92% of professional alternatives over 20 years. That is not a minor claim. Level 2 is recognizing that most so-called diversification isn't genuinely diversification. It's fee multiplication. If you hold 15 mutual funds and 12 of them contain essentially the same S&P 500 companies, you haven't distributed your risk intelligently. You've paid 12 sets of fees for 12 copies of the same exposure. The Bessembinder data suggests that the argument for index funds isn't that they spread you equally across everything. It's that broad market index funds automatically include the 4% of companies responsible for generating all the gains at near zero cost without requiring you to identify them in advance. That is a fundamentally different argument than spreading your money everywhere as a form of protection. You're not protecting yourself. You're purchasing access to the winners without needing to locate them. This matters because it means you can accomplish level 2 with 1 or 2 funds, not 15. Level 3 applies to people with the time, discipline, and genuine expertise to operate the way Buffett described in his 1993 shareholder letter. If you are what he called a know-something investor, able to understand business economics and identify 5 to 10 sensibly priced companies with meaningful long-term competitive advantages, conventional diversification makes no sense for you. It will simply hurt your results while simultaneously increasing your risk. But level 3 requires actually becoming that investor. Most people won't, and that's a completely rational choice. The unglamorous middle ground, the place almost nobody ends up because it's too straightforward to feel sophisticated, is 1 or 2 low-cost, broad market index funds, total annual fees under 0.1%, automated contributions, and 0 quarterly interference. That's the entire prescription. Morningstar found that over the past decade, investors in U.S. mutual funds and ETFs earned 7% annually, while the funds themselves returned 8.2%. That 1.2 percentage point annual gap means investors missed approximately 15% of their funds' total returns. The irony is complete. The less you do, the better your outcome, and the financial industry cannot generate revenue from that. There's nothing to sell to someone who buys one fund and never picks up the phone. Here's the figure that should permanently reshape how you think about complexity inside your portfolio. Very few people have built wealth on their 7th best idea, but a significant number of people have built wealth from their single best idea. Buffett's longtime partner was characteristically blunt. A lot of people think that if they hold 100 stocks, they're investing more professionally than if they hold 4 or 5. He described this as insanity. A manager who built one of the most celebrated hedge fund records in history called Diversification, the most destructive and overrated concept in the investment business. The most celebrated investors of the modern era share a common characteristic. They make substantial, concentrated investments